Despite a turbulent economy, the South African property space has seen robust activity over the past year with 8 new listings. But how healthy is the property sector currently, and how are local companies reacting to the current risks that we see in the economy? Joining us to discuss this is Petri Redelinghuys. He's a senior trader at Inkunzi Wealth Group, and John Loos. He's a household and property sector strategist at F&B. Gentlemen, thank you so much for your time. John, let me start with you and get the lay of the land in terms of how the property sector has been doing over the past couple of years or so.
Well, if one takes the 3 main sectors of the commercial property sector, the retail, they're all off the boil. After the recession of 2009, there was a returns recovery. If you look at the IPD stats, peaked about 2013 and has since been tapered off a little, but still reasonable returns. To give you an idea, last year their total retail returns was 14.3%, and then the industrial and office space nearer to 12%. So the retail sector was still the best of the 3 last year. Not surprisingly, because real retail sales growth held up reasonably well under the economic circumstances. Industrial, a bit more pressured, with manufacturing not so good. And the office space for years has been the underperformer with very high vacancy rates, bit of overbuilding. So that's probably where we stand in terms of relative performances. Starting to be affected, I think, slowly by 4 years of economic growth stagnation. And of course, there's rising interest rates as well.
Well, John's highlighting all of those factors in the property sector, low economic growth. So we've got new 8 listings that we've seen in the property sector, clearly not deterring them.
So there's a theory that says when the ducks quack, feed them. I think we've been seeing a lot of companies do IPOs, and we usually see record numbers of IPOs just before, spaces like 2008 or 2000 or those kinds of things. So again, being super bearish, I suppose. But there's been a lot of IPOs coming to market. To be honest, I don't think that there's really enough space for all of these companies. So some of them have given really big returns, but the big players are still dominating the space, the likes of Growthpoint and CCO and Nepi and those guys. And to be honest, I think that would probably be the safer bet. Although, John makes a good point. Interest rate cycle, economic headwinds. To me, not a very good time to be in listed property.
Good time to be in a property market in general. Next week we've got the MPC decision, interest rate hiking cycle. What does this mean as an investor in the property market?
I think that, it's obviously very difficult to time these super cycles because it's many years before you get to that ideal bottom of the cycle turning point. The last big buying opportunity was probably back in the late 1990s or somewhere early last decade. So it's always tough to, if you want to get into property, to do it right. But I do believe that in the coming years, I think this economic stagnation is here for a while. I don't think, there's nothing obvious at the moment in the commodity prices or anything globally that says we're going to turn and start booming be substantially better. So you've got this lengthy super cycle stagnation, I would say. And I think that for a couple of years, you'll probably see sliding commercial property returns. So I don't think the big buying opportunity is here yet. I think it's probably a few years away. But yes, that's, super cycles are long, and it's always difficult to say exactly when you want to be in property. What I would say is investing in property now, in stagnant times, I think is about quality. Marginal areas, marginal shopping centers, marginal business nodes, I think are more risky and more likely to possibly deteriorate and even decay in stagnant economic times. The prime ones would probably hold up better in more adverse times. So it's really got to be about, in principle, a flight to quality if you are in the sector.
Flight to quality, the big players that we've seen, you mentioned Nepi, Redefine Properties, huge investment into Poland with that Polish acquisition. Is this the way to go? Should we just be heading to those particular markets in Europe in the hopes that, this is where you get your returns?
A lot of companies have been going offshore to try and diversify earnings. And if that's one of the things you want to go for, you'd rather go for something like Growthpoint, because I think 16% of their total portfolio is offshore at the moment. And also they tend to target the higher LSM type buildings. So we've seen from a consumer perspective that consumers in the retail retail consumers in the higher LSM brackets are very resilient. We've got fancy new brands coming into South Africa, and people are still going to Sandton City all the time.
Or Rosebank for their
or Rosebank,
Starbucks.
or they're going to the really expensive places. So those people who are in the upper echelons of society tend not to really feel the economic difficulties that the rest of us do. And Growth Point, I think, is targeted more towards that type of consumer with the properties that they own. They also do have a lot of vacancy in their sort of business type properties that they have, or commercial properties, office space and so on. But so does everybody else. So you want to look for someone who's resilient in the fact that they have higher end shopping malls under their control, or in their portfolio. And I think also, if you are going for the diversified portfolio play, they have 16% of their money offshore, which is, as far as the biggest players in the sector goes, they have the most exposure offshore. So that would be my pick, I suppose, if I had to pick one. Alternatively, a very good alternative is to just buy the PropTrax 10 ETF, which you just track it's equally weighted index of the top 10 property companies in South Africa. It tracks the index. It's an ETF. It's a wonderful way of getting involved. We're at the top of I don't want to say we're at the top of the market, it's a brave call, but things are going to be difficult. So if you are willing to invest on a monthly basis over the next 10 or so years or more, then an ETF is probably the best way to go. And this, it does still pay a very good dividend yield. I think a lot of people are in this space looking for the income. There's two different types of ways that you could do this. You can look for the income from the share itself, in which case buying a smaller company with exposure mostly locally would probably be a better idea, because my rent goes up every year. Most people's does. Yeah. So you've got income growth. But if you're looking for capital growth, you might want to go for the bigger companies that have offshore exposure, where the weakening rand is going to work in your favor.
John, I want to bring in a couple of points that Petri has highlighted. The economic environment here in South Africa, fancy brands, and then you get the Mall of Africa coming up. You still saw very, very long queues. Earlier on, you mentioned some of the sectors that may be a little bit vulnerable. Whenever these results come out, they'll look at the different, subsectors, and they'll look at office, and they'll say too much building has taken place. Maybe don't go there. Is this what we can expect? Let's again look at the different subsectors. In the office space, that's been the trend with the overbuild. Are we likely to see less office spaces going up? I mean, give us a sense of that. And of course, the consumer, the retailers. Did we underestimate the power of the South African consumer and its resilience? Because there's more of Africa and there's Starbucks.
Yeah, it's. I think. Well, the thing in retail is that people always feel, and sometimes they're right, sometimes they're wrong, that they can outcompete someone else. So the pie doesn't have to be growing necessarily for a new entrant to a market, be it Starbucks or be it a new mall, because there's always someone who'll feel, look, if we provide a good enough product, we'll displace consumers from elsewhere and take away someone else's lunch and bring it to us. That's competition. So my feeling is that yes, in the next few years, you'll probably see a decline in commercial building activity, be it office space, be it retail space. I think you will. But will it be enough to stop the overall national vacancy rate rising? I doubt it. I think that the economic environment we're in, you will probably see vacancy rates rising. In other words, we don't cut building necessarily quite enough to suit the demand. We probably overbuild a bit relative to weakening demand, and I would expect vacancy rates to rise.
Let's just get some of your final calls. There are different sectors that you can invest in. You mentioned, ETFs as being one investment tools, but listed property as an investment, alternative versus some of the other sectors that you've got, banks, for example.
I think versus physical property, definitely listed property. I'm mincing my words. Simply because A, it's cheaper, and B, your returns are almost always better, and you don't necessarily have to manage the tenants yourself, right? Yeah. So if a building block to a portfolio, yes, 5 to 10% allocation perhaps in property. But there are alternative investment classes. I think currently resources is all the rage, because we've had a tremendous rally from the beginning of the year. Whether or not that will last, I'm not sure. To be honest, I think cash is not a bad option. Earning some interest for the next year or two is maybe not the worst idea. Property, sure, if it's a diversified portfolio. you could get some exposure to that. But if you were going to do that, if I was going to do that, I would do it through an ETF rather than trying to pick a particular company.
Gentlemen, thank you so much for coming in this afternoon, giving us a bit of an update of what's happening in the property space and those strategies, instead of having to look after tenants or managing them, maybe then you can look at the listed property space. Thank you so much. Big thank you to Petri Redelinghuys. He's a senior trader at Inkunzi Wealth Group, and John Loos, household and property sector strategist at F&B.